mixed emotions. We're really saying that we're not entirely happy with our trading results. We might have had some success, but then we've given some of that back. We might have given too much back to the market. So we're trudging along. We're maybe making a little bit of headway, but we're not entirely happy with what we're doing with our approach to investing, and that's what we want to solve today.
Very good. Okay, well, Mike, I think we're back on the screen here. We've actually kind of introduced ourselves a number of times, so I'm going to say, let's kind of skip through that, okay? Rather than going on and on about who I am and what I've done and so forth, I think the information that I have to share is going to speak for itself, okay? And Mike, though I love to introduce you and your story, I think we're going to have to just blow right through that, okay?
No problem.
All right. I'm going to ask folks to hold your questions until the end, okay, so that Mike and I can give our full attention to the presentation itself, but at the end we will be able to take a few questions, okay, or perhaps Mike will take a few questions. And if you participate in the polls and the prompts, it's going to help you get the most out of today, okay? All right, now I'm going to make a bold promise, and that promise is that I'm going to show you a simple truth, and it's the principle that all successful traders have said over and over. Okay, but they've often said it without the practical direction on how to achieve it. Okay, cut your losers short. That's the beginning of the sentence. I wonder if anybody can finish that sentence for me. This is supposed to be the maxim, the bylaw, you know, that folks live by if they're traders. Okay, who can finish that sentence for me? We've got 55 attendees. I know that somebody knows the rest of this saying. Cut your losers short, yeah, and let your winners run. Okay, it's coming in now. We've got piles of folks answering, and yep, very good. Well, thanks, folks. Let your winners run. Now, I'm going to ask you a question, okay? That sounds familiar. Of course it does, right? But does everybody do that? No, they don't. Well, what if there was a way to force yourself to always do this? What if you could guarantee that you would always do this? Would that be of benefit, do you think?
Oh yeah, it'll take a lot of the work out, you know, a lot of the management out as well. If you set yourself up in a position where this can happen automatically with the setup that you have, then you don't have to worry about watching your screen consistently. You don't have to worry about trying to adjust every time there's a small move in the stock, and your portfolio will greatly show returns that will benefit from that.
That's right. I'm going to make a promise, and the promise is that today I'm going to show you a practical, workable, and reliable way to put this principle to work, and it will instantly improve your trading results. In fact, we're going to confirm that a little bit later on, that it will instantly improve your trading results. We're going to confirm if what I'm saying is true or not. Okay. Now, the blueprint has sold in over 25 countries. It's strangely, they say that an expert is somebody from out of town with a briefcase, right? Strangely enough, we've had a lot of international sales, and here in our own backyard, less folks know about it than I would like. Okay, but folks that have purchased the blueprint, or folks that have gotten into radioactive trading, have found and have commented to me and also to you, Mike, that just what we share in the free presentations, like what we're doing today, has been a better boon to their trading than perhaps a weekend seminar where they would learn so-called advanced strategies and be charged over $3,000. Have you had more than just a few of those kinds of comments?
Oh, absolutely. Over the past 8 years at Power Options, we've had a lot of investors who have gone through these different seminars, even ones ranging up as high as $6,500 for the weekend, and they always come back saying, okay, something's not working right, and I followed all the instructions. What am I missing?
Exactly. Well, folks, that principle that I say is more valuable than the $3,000 seminar, I'm giving that away today. But in return, I'm going to ask something, okay? And here's what I'm going to ask. At the end of the webinar, you know, most of what we're going to do here is not a sales job, okay? Most of what we're going to do here is instruction. But at the end of that webinar, I will be making a special end-of-the-year offer for some products and services that will even further enhance the training. Now, I don't want anyone to invest anything in any program, including mine, unless promises are fulfilled. Today, I'm going to show you how to instantly improve your results. Okay? And if I do, if I fulfill that promise, I would think that you would only feel that it's honest to take advantage of my offer if it's fairly priced, right? And has an ironclad risk-free guarantee, meaning that, geez, you know, if you don't find that it gives you the benefit that you were looking for, man, we'll buy it back. Okay, is that fair enough? Let me just have some folks answer. Thanks, Dave, for participating in the last one, and Marcus and Emil and Lidween. Okay, Joe says yep. Paul says yes. Thanks, guys. Okay. Well, let's move forward, okay? Because again, this is all about instruction. Let's review that saying. The saying is, cut your losers short and let your winners run. Okay. Now, let's see if the strategy of selling covered calls or selling naked puts is congruent with that idea. And I know that we've only got 40% of our audience is doing covered calls. Okay. But let's just take a look at that, because that was my introduction, so to speak, Mike, to options.
It's the gateway strategy.
It's a gateway. Just like they say, tobacco and alcohol are the gateway drugs, you know, to the hard stuff, right? Well, covered calls trading is the gateway for a lot of folks that learn to get involved in options trading. Well, options trading can be wonderful because it's a hedge. Mike, in the case of a covered call, that is a hedged trade, isn't it?
Sure enough. I mean, we're buying stock, which means we're bullish. We're expecting the stock to move up to earn profit. That's where most of our investment capital is, purchasing shares of stock. But at the same time, we're going to sell a call against it, which obligates us to deliver shares of stock at a set price. We collect a premium for that, but what have we done? We've taken that bullish position and capped the gains by adding a bearish position to it. The most bearish thing you could do, other than shorting stock, is to short a call by itself, a naked call.
Right. And I want to be real clear about something here, Mike. This is not my graphic, okay? I stole this. I mean, I borrowed this off of Options Express site. Okay, their education portion. I don't necessarily agree with this segment here where it says that the risk of covered calls trading is necessarily safer.
And let's be honest, it's just not Options Express. It's every investment group, every brokerage house will show the same process, will show that they believe that covered calls are safer, which is why when you first apply to trade options, you'll be allowed to do covered calls because they feel it's a safer technique.
Yeah, it's mind-boggling to me why folks, brokers will allow you to do covered calls trading that won't allow you, you know, as a neophyte, as a beginner, they may not allow you to do a bull call spread. That's crazy to me. You know, with a bull call spread, your risks are predefined, right? But in the case of a covered call, you know, you could get hurt. Well, anyway. I'm not going to wax philosophical about that. I think that everybody that's involved in covered calls trading has already found out that you know, maybe it's not as safe as what we think. But Mike, what about that saying? Cut your losers short and let your winners run. Is this strategy congruent with that?
Not at all. It's the reverse of that, isn't it? What we've done here is we're still taking on close to 100% of the risk of just buying stock outright, but then we've capped our gains to a limited percentage. We're not allowing our winners to run.
Gunther wrote in a comment. He says it's safer for the broker.
That's true.
I guess so. And the broker is, you know, his job is to make you broker.
Well, what he means, of course, is that when you do the covered call, is that you have the stock in your account to buy the shares. So there's no way that you can get stuck with a margin requirement or a margin loss and then not have the money in your account to fulfill the obligations you took on. The broker knows at least you have the money to put in the position in the first place. So you can't lose more than that. But
that's right. That's who's covered by the covered call. The broker has your bets covered. Well, I got this weird idea, Mike, and again, this is a hedged position. It's a mixed position. If I'm buying stock because I'm long on stock, or I'm bullish on the stock, I should say, all right. But rather than mixing that stock ownership with a covered call, how about mixing it with a long put? Well, a long put is also bearish, right?
Absolutely.
But overall the strategy is still bullish because the major component of it is stock ownership. So would you agree with this portion right here where it says risk is safer?
Well, absolutely, because I know my risk going in. I've set it up to a limited monetary amount or limited percentage amount because I essentially bought insurance on my long shares of stock. It's predefined. I can't lose more than that amount in the worst case scenarios.
That's right. And I'm going to go ahead and mention something here, Mike. Looky here. It doesn't say limited. It says unlimited. And is that in fact true?
Absolutely. If the stock takes off and it just continues to move up in price, like we saw with Silver Wheaton in some of our examples, and your Green Mountain Coffee Roaster example from a couple years ago, you still take advantage of that upside gain without having any cap or any obligation to deliver shares of stock at a lower price.
That's absolutely right. Mike, in 1999, I was following my broker's, not my broker, my guru's instructions, and that fella happens to be in jail now. But that aside, I thought he was a good teacher as far as getting the concept of what a covered call was across to me. I understood because of his teaching, but I didn't understand risk, and I'm not going to blame him. It is my fault that I got greedy and I looked for the highest premium paying covered calls and bought stock and sold calls against, and I did it on margin. I did something that my guru had said to do, as far as, increasing your percent return. He said that, geez, if you do this on margin, you double your return. I thought, wow, I'll do that. And I ended up going completely broke. Okay, but Mike, by October 2002, I had learned to mix options and stock the right way using married puts. And I had built up some capital, and I got into Yahoo and eBay and Amazon. For example, Amazon I picked up at $16.09. Now, if I were a covered call seller still, what I would have done is sell the $17.50 calls. But I'd have felt like a chump, and here's why. I bought the stock, I bought a put, and then Amazon went to $63 in the next 13 months. How about them apples? Okay. Well, what I did, Mike, was start blogging about it. Okay, I started writing about it, and pretty soon folks were asking me if I had written a book, and this is the truth. I actually said, well, if you'll buy it, I'll write it. And I took pre-orders, and I disclosed to everyone, hey, look, I'm going to I'm going to write this if I get enough orders, but if I don't, I'll just return your money. And what happened, of course, is we collected more than $2,000 worth of orders before I wrote a word. And since then, Mike, I've been really committed to giving away quality information for free. Okay. I know that teaching the general strategy for free takes some effort, takes some time, but it reaps great rewards, not just in the case of increasing sales, but also in the fact that hey, I know that I've helped some folks save their bacon. I've gotten a lot of thank you letters, especially in November of 2008. We got a lot of thank you letters. Okay, so over $500,000 in sales later of the blueprint and related products. I still believe in giving folks the value first, showing you what you're going to learn, okay, and then make more available. Today we're going to do the setup, and we're going to also show 2 income methods out of 10. There's 10 income methods. Now, just before we go into this, we had a question come up, gosh, why not just go long on the call? That's far less capital than a married put. Well, that question was posed by Farjud, and I've answered that question in a number of forums. Okay, and using a married put, you do a lot better with the forced money management. Let me ask you something, okay, Mike? Let's say we've got a trading record of 2 losses and 1 win. Would you rather lose 5% on a loser, make 20% on a winner, and then lose 5% again? Kind of modest, okay, there with the married put trade. Or would you rather use leverage, okay, for example, margin or a call option? Would you rather do something that would leverage you? Now let's see what the uses of leverage could do. Okay, whoops. How about we multiply everything times 8? Now if we multiply everything times 8, when we lose 5%, well geez, we're going to lose 40%. But if we make 20%, geez, we're going to make 160%. That's better than doubling your money. You know, 100% gain would be doubling your money, right? So 160% gain is better than that, right? But then lose 40% again. Now, quick, which is better? I want Farjude to answer me. Don't get out your calculator. Just tell me what you think. Okay? Lose 5%, make 20, lose 5% again. Or lose 40, more than double your money, make 160%, and then lose 40% again. Which is better? Frank says the first one is better. Others? Guys, I'm not going to give you time. Oh, second. Somebody, is this Pierce or Piers? Says the second is better. Well, you know, it appears better. Look at this, Mike. It looks like you lose 5%, you make 20, you lose 5. That's a net of 10%. That's what it looks like on the surface. Here you lose 40, make 160, lose 40. That looks like a net of 80% gain. Okay? But that's not how the math really works out. It isn't. Okay? Listen, if you lose 5%, then make a gain of 20%, then lose 5% again, you'll have a net gain of 8.3. Check me on this, but check me on it later. Okay? Maybe jot this down right now and check me on it later. Okay? I don't want you to use your calculators now and miss something else that's really important. Okay? Now, if we multiply everything by 8, a 40% loss and then a 160% gain and then another 40% loss, that yields a net loss. That didn't seem right. But, Mike, that's how the math really works. The reason for that is because losses to what you have to do to get it back is exponential. It's a logarithmic scale. The more you multiply your losses, the more you're going to get in trouble. And if folks tell me, well, geez, you know, I want to use a long call because it's going to use less capital, it's more efficient, I'll agree. It's more efficient at losing you money. Mike, if you do a married put position, you're going to risk the same amount of capital, but it's going to be a much lower percentage. Mike, what if we increased our leverage from 8 to increase it to 10, okay? What if we were to have a 5% loss, then a 200% gain, triple our money, and then 50% loss again? I'm sorry, 50, 250. Well, that's going to be a net 25% loss. See, increasing your leverage by just a little bit, instead of having leverage of 8, now you have a leverage of 10. Now you've multiplied your losses by 4. Okay? The more you leverage yourself, the more the losses hurt you. So is leverage really the way to go? You see, the lie of leverage is that, you know, leverage can be used against you too. Mike, my day job, which I actually do at night, my job for the last since 1986, so I guess it's been 24 years, is that I teach people how to get in the ring and fight. I've been teaching mixed martial arts and kickboxing and jiu-jitsu for a number of years. Now, here's the thing. I don't fear, when I weigh 160 pounds, when somebody comes into my classroom and they're 210 and they're 20 years younger than me, I don't fear them at all. And here's why. Because I understand principles of leverage that can make me help them look like you know, a kitten with a ball of yarn. I can toss them around with no problem. Here is a problem, though. Once that 210-pound dude that's 20 years younger than me, once he learns all the same principles of leverage that I understand, now I'm afraid.
Right.
And the thing is, the market is bigger than you, okay? And the market does understand leverage, okay? And so anyway, the folks that argue that a married put is the same as a long call should really look into the deeper math behind it, okay? All right, now, Mike, we're going to save this exercise for Thursday, okay? We're going to save it for Thursday, but let's speed ahead, okay? What I'm referring to right here is the trade simulator tool on radioactivetrading.com, and it'll share basically the fact that you can actually be wrong more often than you're right and still make money. Okay, if we have time to come back to this, we will, but we're going to definitely do it on Thursday. What I wanted to do is fulfill my promise today to everyone, and
Okay.
that was to show the structure of a radioactive profit machine and 2 of the income methods. Okay. All right. So here's an actual radioactive profit machine recently closed on September 14th, 2010. I bought Altera shares at $27.35. At the same time, I bought a March 2011 $29 put option for $3.50. Now, my total invested there is $30.85, but I've got a guaranteed exit of $29. So what's my at-risk amount, Mike?
Well, when you bought the put, of course, that's what guarantees you the exit. That gives you the right to sell your shares of stock at $29 anytime between now and March expiration. So the most you can risk on this position, the most you could lose in the worst case scenario is $1.85. But you have taken a position, a stock that's at $27.35, and invested $30.85 into it, haven't you?
Right, and that's what a lot of folks will look at. They'll say, hey, Kurt, you know, come on, look how much you're spending for that insurance. That's really, really expensive. And my reply to that is expensive compared to what? You know, the person that is that owns a home, for example, is going to probably buy insurance for it. They're a fool if they don't, right?
Right.
How about folks that drive a car? In Colorado, if you drive a car that's not insured, you go to jail. You know, I mean, it's that important that they force you to do it. Well, you know, the same instrument is available to folks in the stock market, but they don't take advantage of it. Okay, and here's an insurance policy. Well, Mike, I'm going to hit another poll, okay?
Okay.
And ask what folks think, okay? When you hear a new idea that contradicts what you've heard before, what do you do with it? I have a couple of folks online asking me about long calls and so forth. What's the difference of just buying a March 2011 $29 call? Well, I thought I handled that leverage question just a moment ago, but I'll handle it in another way. The call is going to cost more than the total amount that is at risk in the example that I showed. And what you can do is go through my blog, and you can go through the YouTube videos and take a look, okay? All right. And let's go ahead and close and share the results here, Mike. 0% say I rejected out of hand if they see a new idea. 27% say they're suspicious but check everything out. 70% investigate fully. Look, folks, I want to encourage everyone to do that. All right, and 3% believe everything anyone tells me. Hey guys, don't do that. Don't do that. You know, it's just like my uncle, the farmer, said. He says, "Hey, you know, trust your neighbors, but brand your cattle." Okay, let me go ahead and share what's going on here. Look, we've got 6% of the underlying capital at risk.
Okay.
Okay. Now, if the stock goes up, we're going to make money, okay? But if it goes down, we can't lose too much, and that's really the key here. This dashed line here is the break even, and a lot of folks believe that once they buy the stock and buy the put, then that they've necessarily already raised the bar to where that stock has to go up before they're going to make money. Is that necessarily true?
Well, no, not at all. I mean, we're not driving a new car off the lot here. This risk is the worst case scenario if about 3 things are satisfied. If we hold the position all the way to expiration, we make no further adjustments, and the stock's still trading below our put strike price.
Right. Okay, so if the stock does not go up and we hold it all the way till expiration and we make no adjustments, then you could possibly lose this much. But guess what, Mike? That much represents, in the example that I just showed, represents 6%. And almost immediately we're going to start messing with that. Okay, we're going to talk about that. But just before we do, let's compare owning 3 positions. Okay, Mike? First of all, if we own straight stock, or if we do a covered call, or if we do a married put and it's all in the same stock. Okay?
Okay.
Well, let's say that we're trading and the stock goes up 20%. Well, how much do we make with the stock?
We're going to make 20%, right?
20%, right? Okay, now with the covered call, we're going to limit our gains, aren't we?
That's right.
How much happens with the covered call? Yeah, if we sell a call and then we get assigned, okay, then we're going to only make a certain amount. But with the married put, you know, our what we pay for the premium is going to cut into the profits a bit, isn't it?
That's right. Mm-hmm.
Yeah, it's going to cut into the profits a bit. Let's be honest here, okay? But here's our situation after one play. Now let's say that we take our money or our losses out of that. Okay, everybody made a gain. Let's take our gains out of that, and then we'll invest it into a new stock. Okay, new play. And now the stock goes down by 20%. Well, how much do we lose on the straight stock?
We're going to lose 20 again.
20%, okay? The covered call, the loss is going to be less, isn't it? Because we collected a premium. Okay?
Yeah, we're going to keep that premium, sure.
Yeah, we get to keep the premium, and maybe we can even do it again, okay? But the married put, boy, you know, it loses only a small amount. And Mike, the way that I showed the setup was with Altera is that it would lose 6%, okay? But again, we chose a put that was 6 months out in time. If it's 6 months out in time and the stock goes down a little bit, even goes down 20%, am I going to realize that whole 6% loss, or is there going to be a little bit of time value left in that?
No, so you're still going to have time value left. So even if the stock dropped down 20%, you're well below the strike price of your insurance policy, you still have time value remaining on this particular put option. So your loss might only be 2.5% or 3%. It's not going to be near that 5%. Well, I mean, it's going to be near to it, but it's not going to be the full 5%.
Right. I've been doing this for the last 3 years publicly. I mean, I've been doing it publicly for longer, but I set aside $100,000 into a particular account over 3 years ago and began publicly trading. And Mike, even through the crash, over the last 3 years, my average loss has been 3.9%.
Mm-hmm.
Okay. So so let's say that this 5% is actually, you know, doable. Okay, because, well, it is. Anyway, let's look at these three situations, okay? The straight stock makes and then loses 20%. So what's the net?
Okay, so makes then loses 20%. We'd be right at zero, wouldn't we? No.
That's what most folks believe. They mostly believe that, hey, if I make 20% on my winners and I lose 20% on my losers, then I'll be even. But that's not the truth. There's a net loss of 4%. Here's why. Okay, 20%. Well, let's take $100 and let's multiply it times 1.2. That'd be a 20% gain, wouldn't it?
Mm-hmm.
Okay, so we take our $120, right? And then we multiply that times 0.8, right? Because we have a 20% loss. What do we end up with?
Ugh, not good.
Yeah. Check the math. Okay, the fact is if you lose 20%, you have to make back 25% just to be even with where you started. That's the math. That's the true math on it. Okay, not cool. Okay, how about the covered call? We make 5% and then we lose 15%. Okay, it looks like a 10% net loss, doesn't it?
Mm-hmm.
But no, it's actually more than that. Okay, it actually is a 10.75% loss. How about the married put? Okay, we make 15%, then we lose 5%. So that's a net 10% gain, right?
Mm-hmm.
No, that's not how it works out. We make 9.25%. Okay, but still, out of the 3 plays, which one came out smelling like a rose? We had same market, different end results. The stock-only strategy, we lost 4%. The cover call strategy, we lost 10.75. And the married put strategy, we had a net gain. Same stock, same record, right? Same market. It's because of that maxim that we said before. You cut your losers short and let your winners run. Now, Mike, I'm going to pose a question here. I'm going to just ask a real simple question. We had about 30%, and a lot of folks have joined us since then. We've had 18 attendees join us since then, so I don't know if the numbers are still accurate. We had 32% say that they were happy with last year's trading. Okay. Now, if you could keep your wins from last year, but all of your losses were 6% or less, would that have changed your answer? Or if it was yes, would it still be yes? Okay? Give it some thought, guys. Don't break out your calculator and take a long dissertation through all of your stuff, but let's think about it. Who would have said, yes, I'm happy with my trading results? Who would have said, no, I'm not happy, but I'm closer to yes? Okay? And who would have said, no way, I'm still not happy with my trading results? Now, this is the promise that I made, Mike. My promise was that I was going to help folks in this very presentation. We'll give you another 5 seconds, okay, and then that poll will have been up there for a full minute. And presto. Share. Mike, is 60% better than 32?
Yes. We
Okay.
almost doubled it, yeah.
Yeah, almost doubled the number of people that would be happy with their trading results. 34% would have said no but been closer to yes. So I'm going to say that if they're closer to yes, then doing a strategy like this would have mitigated their losses or improved their results to where they were more satisfactory than they were. Does that make sense?
Absolutely.
Okay. And only 6% were contrary to that. Only 5% would have still said no. Well, I've got to assume that your losses were less than 5%, right?
Yeah.
Okay. If your losses are less than 5% on trades that you're making and you're still losing money, you're doing it too much. You are over trading. If you lose 5%, just every day, you're going to run out. Okay. All right. But for the most part, 94% of our audience would have improved their trading results, like I promised at the beginning. 94% would have improved their trading results. I'm going to ask a follow-on question before we show the income methods. I just want to ask a simple question. Can you put a number on it? You can put a number on it. How much more would you be further ahead? Okay. Either number one, you can't see that, forcing yourself not to risk too much would even help. Okay. Number two, you might have saved at least $300 on your worst loss last year. Next, you could be ahead by between $1,000 and nearly $5,000. You could have saved or made $5,000 or more, or you recognize the truth that, geez, when you don't lose too much on your losses, you can actually buy at the bottom with most of your capital. Interesting. Okay, Mike, let me go ahead and close this poll and share the results. We'll give them another 5 seconds.
Okay.
And close. Okay, look, nobody said I can't see how that would even help.
Good.
So that's good. It shows that, everybody's math literate. Okay, 11% would have saved at least $300. Okay, great. 21% would be ahead by $1,000 to $5,000. 61% would have saved or made $5,000 or more. And 7% would have really taken advantage of this and, applied their timing and done real well. Mike, is it safe? I mean, is it too bold of a claim? Am I like way out in left field to say that I've just given a key to someone out there, to everyone out there that cares to apply it, that the next 12 months could be better than the previous?
Yeah, where does everyone want to be if they get asked these questions 12 months from now? What do you want your answer to be?
Right. If I ask you this question 12 months from now, what will the answer be? Okay. All right. Let's go ahead and hide those results. Mike, again, it's back to the principle of let the winners run, cut the losers short, and using the married put. Okay, you actually kind of force yourself into that kind of a situation. Does it fit now? Does that saying fit with that strategy? Okay. All right. So far, we actually already did the poll. Let me just share it again. So far, Mike, 61% say that they would have saved or made $5,000 or more. I think I just saved or made you $5,000 for next year, if you apply what you've learned. Okay. So that's that. Okay. Now let's get into the income methods. Okay.
All right.
All right. Just to review, September 14th, 2010, pick up Altera shares at 27.35. The March put for 350. Total invested is 30.85. Now, Mike, when you first saw this kind of setup where I buy in the money far out in time, so that's 7 months out, not 6 months. That's 7 months out. All right. When you first saw that, you said, I don't think you can make any money with that, right?
I said, yeah, I mean, looking at this setup, you're not going to make any money until the stock's trading at 30.86. You're going to have to realize a significant gain in the stock for you to profit. So I understand that you're protecting your position, but your expectancy of profit here is very low.
Right. You know, almost everybody will look at that and say, geez, Kurt, you know, paying for that put option really cuts into your profits. You know, if you're spending $30.85, you're not going to make a penny until your stock goes to 30.86. Well, let's see if that's so. Okay? Let's see if what intuitively we think of about the math really is so. Okay? Here we are. Oops. This ran together. Mike, on September 24th, 10 days into this position, I applied income method number 5, the money net, okay, where you buy one call and sell two at a higher strike. Oh boy, the formatting just messed up. I guess you can see it over here. Okay, I sold two October $29 calls at 85 cents. Okay, getting netting 170 in premium. But at the same time, I used some of that to buy one October $28 call for $1.45. Do you see that? How it comes down? Okay. So the net credit for the spread is 25 cents. All right. Sorry, guys, for the formatting. That'll teach me to make changes just before a presentation. The changeover to PowerPoint just didn't work out. Okay, but here's the point. Okay, Mike, I had a total amount invested of $30.85, like we discussed. You know, the put plus the stock. Now, doing that ratio call spread in the context of my married put position lowers the cost basis, doesn't it?
Yes, you did receive a credit, Kurt, so you drop your total invested into the position, your total out of pocket from $30.85 down by 25 cents, so now you've got $30.60 invested. Okay,
and so now I still have a put option that guarantees my exit at $29 in case the stock falls out of bed. Okay, so the remaining at risk, the most I can lose is no longer $1.85, now it's $1.60. Okay, all right, so that's what happened there. Okay. Now,
that was the action.
That was the action. Okay. Now, on October 15th, Altera was trading at $29.40 when I did the following moves. Now, Mike, this is expiration Friday. All right. October 15th was expiration Friday. Now, since I've shorted, you know, the calls at $29 strike.
Yes.
And the stock is trading at higher than $29. What if I want to keep the stock? What do I got to do?
You got to pay money. You're going to have to cancel your obligation by buying to close your short calls so you don't have to deliver your stock.
Okay, now remember, I had received 25 cents for doing income method number 5. Our spread traders are going to really enjoy this, okay? I had received 25 cents for doing income method number 5, and I needed to pay 55 cents to close short calls, okay? So does that look like a really great situation?
Oh, no, you're going to be adding more risk back into the position, aren't you? Because it's going to be a 30-cent difference.
Yes, but let's not forget this, okay? Back on September 24th, I had bought one $28 call and sold two $29 calls. By doing that, I collected 25 cents, okay? On October 15th, I bought back just one call, okay, at 55 cents. So what's that leave me with?
Well, it still leaves you with one short call at 29, a long call at 28, long shares of stock, and long a March put option with a 29 strike.
Right. Okay, I apologize for this. Apologize for this formatting. Boy, can everybody see that up there? Net credit for the original spread was 25 cents.
Yeah, I can see that. Yeah, it's
okay. I'll have this fixed by Thursday there, Mike. Okay, but my credit received on September 24th was 25 cents. And then to buy to close the one call was 55 cents. So yeah, I spent 30. Okay, but let's think about it. Let's look at it another way. When I had bought one and sold 2 calls against the stock, it was kind of like selling a covered call to finance the purchase of a bull call spread. For example, being long the 28 and being short the 29 would be a bull call spread, right?
Yes.
And so I've got a bull call spread going on. This is what my spread traders, I think, would enjoy. But added to that, along with that, I also had another short call. But that other short call paid for this bull call spread. Does that make sense?
Mm-hmm.
Okay. By closing one of the shorts, I left that bull call spread in place. Okay? So I've got the long $28 call. I've got a short $29 call. And my debit so far is 30 cents. Remember? Collected 25 cents, then paid 55 to close half of the shorts.
Okay. Mm-hmm.
All right. So in the middle of the night, here's what happens. Okay. At midnight on October 16th, my broker buys Altera shares at $28 because I've got long calls. And this is called automatic exercise. Also, he recognizes I have an obligation to deliver shares of Altera at 29, and so he does that. So he buys at 28, sells at 29, and because of my management of the income method number 5 trade, I've paid out 30 cents total, but I have a guaranteed dollar from this bull call spread.
Mm-hmm. Got it.
All right. So where I come from, that's a 70-cent credit that I caught in the money net. Plus, I get to keep a stock that's gone up. Pretty cool?
Mm-hmm. Okay.
Okay.
So we've got that set up now.
All right. So it had been $30.85 in the beginning to set up my RPM, my radioactive profit machine. I received a 25-cent credit, so now I have an adjusted cost basis of $30.60.
Mm-hmm.
Okay. Then I add in 55 cents to buy back one of those calls, and then the cost basis after the buyback is $31.15. Okay, and then the $29 bull call spread closes in the money, so that subtracts another dollar from my cost basis. So my new cost basis is $30.15. Got it?
Okay, so we've reduced the cost now by about 70 cents total. Is that correct?
By 70 cents. That's right. We've reduced the cost basis by 70 cents, and I am still long the stock, and I still have the put options protecting me all the way out till March.
Mm-hmm.
Okay. All right. So doing income method number 5 reduced the gap here. Now I can no longer lose $1.85. I can only lose $1.15. But
Right.
you know what, Mike? I'm not happy with that. I think I'd like to do even better. Okay. Now, do you remember this statement? Hey, paying $3.50 for a put option is kind of expensive. It raises your cost basis from $27.35 to $30.85 a share. You can't make any money until the stock goes to $30.86. Well,
Right.
I don't know about that, because here's the deal. Do you remember before when I asked what would you do if you heard an idea that contradicted something that you had heard before?
Mm-hmm.
What did everybody say? Most folks said, investigate fully.
Right.
Right? Okay. Well, here's the deal. Also on October 15th, when the stock is trading at $29.40, not $30.86, right? But only $29.40, I did the bulletproof vest. Here's the bulletproof vest, Mike. I got rid of my $29 put option for $2.52. It was still worth quite a bit. And in its place, I bought, it says October. That's a typo. November $30 put option for $1.62. Now, do you see that credit there from income method number 3?
Okay, yeah, so you swapped your insurance policy, you closed your March 29 put, which was farther out in time, and you bought a near-term November put, for $1.62. So we gained 90 cents of net credit into the position.
Right. Now, let me tell you why I did this, okay? It's October 15th when I do this, and it's the November. This is a typo right here that should say November $30 put option.
Mm-hmm.
See, earnings were coming out on November 2nd. And because earnings were coming out on November 2nd, I wanted to be bulletproof. I wanted
Right.
to make it so that I couldn't possibly lose. So I took a credit of 90 cents. Okay? So our cost basis of 30.15 was reduced even further by 90 more cents. Do I still have a put option in place?
Yes, you do. But what's interesting now is in addition to changing the time frame, you've also adjusted your guaranteed exit price.
Right. The protective put strike is 30, not 29. Okay? So now, what can I lose?
Well, nothing. You have a guaranteed profit. You have a negative at risk on the downside.
Right. Negative at risk, meaning that I can't possibly lose. Okay? Now that's kind of cool because I did this before the earnings announcement. How good of a night of sleep do you think I got?
Well, I think you were perfectly fine. What was the situation that you're in now, Kurt? Let's look at it. If the earnings are bad and the stock plummets, you're guaranteed a gain of 75 cents. If the stock spikes up because of strong earnings, you still have an unlimited upside potential. And if the stock does absolutely nothing because of the earnings events, well, you still got a guaranteed exit, don't you?
That's right. It can still go higher, but it certainly can't go lower. I can't fail to make that 75 cents. Okay? All right, so one last thing. Who says I couldn't make money until Altera went above $30.85? $30.85 was my cost basis for the stock and the put originally, right? But when the stock is trading at $29.40, by using income method 5 and income method number 3, I had locked in a 75-cent profit or better. I later sold Altera. I held it until the earnings announcement. After the earnings announcement, the stock spiked up, and I sold Altera at a $3.85 per share profit. So essentially, I wasn't given the choice of losing or making money. I was given the choice of making 75 cents or making more. Okay? Now, this whole time I've been talking about this as though it were 100 shares, but the fact is I did this with 500 shares and 5 puts. When I did income method number 5, I bought 5 calls and sold 10. When I managed it, I bought to close 5. When I swapped the puts, I swapped 5 March $29 puts for 5 November $30 puts. Does that make sense? It's all scalable. That's my point.
Now, what date, just out of curiosity, Kurt, what date was this closed? Do you remember?
It was before November expiration. I want to say it was November 5th or 6th, something like that. I'm not certain. I could look it up.
Okay.
Is somebody asking that as a question?
No, I was just curious. With regards to the question that was asked earlier, and I want to just state this really quickly because we only have a couple minutes left before 1 o'clock or 11 o'clock your time, is that, when you entered this position, you had a risk of $1.85. The closing price of the March 2011 29 call on September 14th was $2.15. So it was 30 cents more than the at-risk amount on the married put position.
See, that's what the folks that say, hey, you could do a long call and a long call is more efficient. What they're missing is the Black-Scholes equation. Okay, and I want everybody to hear this for a moment. If you think that it's better to trade long calls than a married put, because some folks have said, hey, it's identical. It's not identical. Let me ask you something. If you placed an order for a married put position and you paid all of your money in and you were instead delivered a long call, would you be happy? Mike, would you be happy?
No, absolutely not.
No, most of your capital's disappeared. Here's the deal. If you're going to trade a long call, the Black-Scholes equation in its pricing assumes that you also have on deposit a huge amount of capital, the amount of capital that it would normally take to buy the stock in the first place in an interest-bearing account. And the interest from that makes the difference. Mike, on September 14th, buying the stock and the $29 put yields a $1.85 at-risk amount. If you had purchased the long call, it would ask for what?
the ask was 215 and the bid was 205. So assuming someone said, well, maybe you get the midpoint, okay, so you get 210. But really, the natural ask was 215.
So what all my critics mention is that they say, well, gee, the call is identical, but it's better. Well, listen, don't make me correct you on math and English. If something's identical, it isn't better. Okay. So what I'm trying to help folks understand is, number one, do not over leverage yourself. Okay. If all the capital that you have only allows you to trade 100 shares in one put, but you can take that same capital and buy 10 calls, all you're accomplishing is overextending yourself and using leverage, and leverage is going to be used against you. I don't know how to make it more clear, but it is available. Okay. All right, Mike. I'm going to go ahead and wind us up here. Bring it home. Okay. Let's see. We've already done a number of polls. I guess I want to ask one more poll. Okay. What would you say has your investment been so far regarding options? And remembering that even in a bull market, over the last 12 months, 32% of our audience said that they were happy with their trading. But 94%? Said that they would be happy if they had applied what I showed today. Okay. Well, what would you say your education has been? Oops, and I blew it. That last question, that final question at the bottom. You know what? Ignore that question, would you? Or that answer, I should say. Ignore that answer because it says it doesn't make sense to the question. What has your investment been so far? We'll leave that up for another 3 seconds here. 2 seconds, 1 second. Okay, close it. All right. Mike, 21%, 1 in 5 of our audience say that that their education has been free. Okay. Okay. Maybe doing things like we're doing today. Today was free education. Okay. Very good. 14% have spent in the double-digit range, say $50 or so for books and so forth. 36%, more than a third, triple-digit range. Certain seminars, will cost around $500. Certain types of clinics. Okay, 29%, another almost third, have spent closer to $5,000. Some of these weekend seminars and weekend special intensives and certain membership sites. Okay, have you spent $5,000 on. Okay, now, Mike, I'm going to go ahead and hide that and just review the offer that we're given now today from Radioactive Trading.
Alrighty.
And here's the components of an offer. Okay, it's what you get coupled with what it will cost, which is an honest consideration. Okay, and what you risk. Okay, here's what you get. First of all, the blueprint contains 250 pages of instruction on limited risk, high potential return trading. Now, don't be daunted by how long it is. All right, the first 3 chapters are going to contain so much that it will help you over the next 12 months. Okay, to do exactly the situation that we talked about. Okay, the setup itself, 94% of our attendees said, geez, if I'd have just used that kind of setup, if I'd have just limited my risk down to 6% and kept my wins from last year, I would have done fine. Okay, well, that's what the first 3 chapters are about, but then the rest, there's 10 income methods, not just, the 2 that I showed today, income method 3 and 5. Okay, there's 3 bonuses with the purchase. Number 1, the quick action guide, which is a $50 value. The Foundations of Radioactive Trading CD, which is an $89 value, and 2 free months of Power Options, which is a $158 value. Now, Power Options is the software that I use to not only locate these kinds of trades, but also to manage them. Okay. All right. Now, what it will cost? That's another part. It's $289 for the blueprint and all those bonuses. And then shipping is $11 in the U.S. I think internationally it can be as high as $41. Let's compare this to a married put, okay, Mike? If the $289 investment were a married put, okay, then $289 is the most that you could possibly lose, right?
That's right. Mm-hmm.
Okay. Well, what if we were to guarantee it completely? If we had 100%, oops, there's the formatting again. Guarantee, 100% guarantee takes that risk down to 0. Okay, so you have a bulletproof trade to begin with.
Right.
So you risk nothing.
No risk. No risk trade.
Okay, Mike, I'm going to go ahead and close her up because I've got to go. If you could take questions, it's certainly available. I'm going to do one quick. I think we've already done a poll. We've done our final poll, haven't we?
Mm-hmm.
Okay.
Was that the last one you had?
What's that?
Was that the last poll that you had? Okay.
I think so. We have 2 months of power options, the Foundations of Radioactive Trading CD, the Quick Action Guide, a $497 value. It's a $289 total cost, and you risk nothing as far as the guarantee is concerned. Okay. You read the first 3 chapters of the blueprint. If you don't feel like just that is worth the $300 that you invested, I demand that you send it back. Okay. However, whoops, here's what you risk if you don't pick this up today. This is the lowest price that the blueprint is going to be offered. After the first of the year, we're increasing the price on the blueprint. Also for the Mastery Series CDs. Okay, if you've already picked up some of those CDs and they're in your library, now it's the single best chance to round out your collection. Okay, and Mike, let me go ahead and push this link. I think this goes to everybody if I do it. Okay. There's the link, radioactivetrading.com. If you'll hit that and then go to the products page, you get all of the bonuses that we just mentioned today. And again, there's 0 risk. Okay, there's really been no better time to get into limited risk investing. So, Mike, with that, I've got to take off. Okay, can I make you the presenter now? And if you have any, if there's any questions,
yeah, I can only. Yeah, I'm gonna. Whoa, I wasn't ready for that. I apologize. I'm just gonna stay on for another minute or two. I'll handle some of the questions that came in, and then I'll log off as well.
Very good. Okay, thanks everybody for coming. I'm one of your hosts, Kurt Frankenberg. I'm leaving you in the capable hands of Mike Chupka, and we'll see you out there. Happy trading, and bye for now.
Okay, Brian asked a question. Mike, I'm sorry, you have a couple questions. Brian, I think the best thing, I might be pronouncing that wrong. Brian, the best thing, send me an email to support@radioactivetrading.com with your questions. I'm not going to be available directly after this webinar in the next 5 or 10 minutes. I'm not going to be available until later this afternoon. So just send me an email with some of your concerns, and we can set up a time where we can talk maybe later this afternoon regarding that. Carl wants to know, can this be applied to futures? Well, hold on one second, ladies and gentlemen. Let me just do something real quick here. Let's see here. There we go. Okay, that might be a little bit better. I apologize for that. Well, the concept of limiting risk, proper money management, Carl, can be applied. Oh, and Gunther asked the same question. Can be applied to any market. The idea is to limit your risk first. Know what you're risking up front. Now, I guess with problems with commodities and futures, you can't directly insure positions one-to-one. But the idea of limiting your risk to a conscionable amount, not risking more of your portfolio in any one trade, can be applied to any market. Is the married put the same as a covered put? Joe wants to know. Well, they're reversed, and the covered put is a little bit more tricky. But the covered put can be viewed. No, I'm sorry. I apologize. My brain's off there, Joe. I apologize. A covered put is the bearish version of a covered call. Okay, in a covered put, you're shorting stock and selling a put option. The risk there is if the stock goes up, you technically have an infinite risk on the position, an infinite loss in the position. If the stock goes down, you might make 2 or 3%, but if the stock goes up, you're still risking a lot. I don't think the covered put is a great approach in that aspect by itself, just as I don't think the covered call is a great strategy by itself over the long term. It works as a sorting machine. In either case, the winners that you are right on get called away from you for a 2 or 3% gain, even though it might have, in the case of a covered put, dropped 10%, you would have had a 10% gain. but all the losers stay with you. You can still suffer a loss of 10, 15, or 20%. Do I think it's worth the insurance? Yes. Since I met Kurt 3 years ago, I've been trading this specifically, this strategy, as well as standard collars in my account, and I've performed better in even a disastrous market, but in similar markets than I did in the first 2 or 3 years of my trading with covered calls and calendar spreads as well. Okay. Lloyd wants to know how many positions do you manage at a time. Unfortunately, Lloyd, there is no real answer to that question. It's what you're comfortable with. When I first started working with Kurt, before I started trading the radioactive positions, he asked me point blank, Mike, how many positions are you trading? And I said, well, I think I have about 17 positions on right now. He said, what are they? I said, well, I have a covered call on this, and I've got 2 calendar spreads here, and I've got a naked put here, and another naked put on this position, which I turned into a calendar put spread. He's like, well, what are the specifics? What is your profit, your potential profit? What is your potential risk on each position? And what are your strike prices? And I said, well, that's why I use the Power Options tools. I don't know off the top of my head. And Kurt told me, and he said, if you can't list for me the risk you have on all of your positions, the specifics of your rights or obligations on your positions, then you're probably over trading. So each one has their own individual values of the positions that they can hold in their account at the same time. I found that mine's about 12 to 15. 15 is the max, but really about 10 to 12 positions is the most I like to hold at any one time. Oh, Brian, I'm sorry. The email address to reach me at, just send it to support@radioactivetrading.com. That way Kurt and I will see it. Carlos, again, as I mentioned earlier, the tools on Power Options just focus on the options markets themselves. We don't look at commodities and futures. The blueprint is geared towards specifically just the straight options and the American stocks, but the concepts can be applied. The concepts at limiting risk and proper money management can be applied to any trading market. Brian wants to know more information about the blueprint. After buying a stock, the stock goes down, and there's still ways to reduce your cost, assuming the stock does not go up again. Well, you can apply income method number 9 and income method number 6 discussed in the blueprint. If the stock goes down, you can still generate income in that fashion. But with income method 9, you need the stock to come back up in order to make a profit. The blueprint does have a whole chapter on exiting the RPM now. So if the stock drops, you can evaluate using those income methods for the bearish position, or if the stock is dropped, or just decide to liquidate the position entirely based on what's discussed in the blueprint, or what your personal preferences and your personal risk threshold, and of course your expectation of the stock going forward after that downward move. To evaluate, maybe you should close this and take, again, 96 or 97% of what you originally invested and then move that into the new position, for example. All right, let's see here. Mark, it depends on how open and how liberal your broker is that you have an IRA. Mark wants to know, what are the items that can be used with an IRA account? If I have an IRA account at Options Express, Thinkorswim, Trade King perhaps, Trade Monster perhaps, or Interactive Brokers, I can probably do just about every income method because they're much more lenient as to what they allow you to do in those positions. Yes, Mark, TD Ameritrade is pretty strict, but I think still, and I could be wrong on this, that Thinkorswim is a little bit more open. My main retirement account is at Fidelity, Mark. Qualified to... In that account, I also have cash accounts at Trade Monster and Options Express. But in my Fidelity account, I'm allowed to trade covered calls, buy calls, and buy puts only. That allows me to do every income method except for income method number 8 and income method number 7. Now, I can't do income method number 5 directly, as discussed in the blueprint, but I can scale it. What Kurt showed earlier with the Altera position, he did a ratio spread of selling 2 calls and buying 1. Well, I can't do that directly in my IRA account. However, if I had 400 shares of stock, for example, in my IRA account that's limited, I could do an income method number 5 that was reduced. In other words, sell 2 calls and buy 1 instead of selling 8 calls and buying 4. So I can still take advantage of that. Well, okay, Richard wanted to know you missed the details on the special pricing on the blueprint. It's not a special pricing on the blueprint. Hold on one second. Let me go back to the main products page here. The blueprint is $289 plus $11 for shipping in the U.S., so it works out to be about $300. And with the purchase of the blueprint, you can get your first month of fishing for only $10. That's where you follow over Kurt's shoulder and watch his trades. You'll get the free Fort CD, which is an $89 value, and we're increasing this. You'll get 2 free months of Power Options, the patented suite of tools that supports over 23 different option strategies. So you'll get that for 2 free months. So the blueprint's still $289 plus $11 for shipping, but you get these 3 bonuses: the 2 months of Power Options, which you can start whenever you want to. You don't have to start right away. Your first month of fishing for only $10, so you get a discount on your first month of $59, and then you get that Foundations of Radioactive Trading CD, which is an $89 value. But the price is still $289 for the blueprint, and then plus $11 for shipping inside the U.S. And then it comes with the 3 special bonuses if it's purchased before December 31st, 2010. All right. Ladies and gentlemen, if you have any other questions that we didn't get a chance to answer, please send us an email to support@radioactivetrading.com. And that way Kurt and I will see your emails. I want to thank you all for joining us this afternoon. Please feel free to join us again. We'll be doing another free live presentation Thursday at 12 noon Eastern Time, so you'll be able to sign up for that on the website. Gunther, thank you for joining us. I'm glad you enjoyed the presentation. Just send me an email if you have any questions or concerns about the radioactive trading techniques or the discussion this afternoon. All right, ladies and gentlemen, take care. Have a great afternoon, a great evening, and happy trading. Until Thursday. Good night.